Welcome to News Beacon, your trusted source for breaking headlines, global insights, and sharp analysis from around the world. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an update. Some business deals simply move money, but others, like General Electric's $2.2 billion agreement to supply engines for China's C919 jet, reshape entire industries. This isn't just about selling parts. It's a high-stakes bet on the future of aviation, where Boeing and Airbus may soon face a powerful new rival. For GE, this deal is a lifeline into the world's fastest-growing aviation market and a calculated risk, putting American technology at the heart of a project designed to challenge U.S. aerospace dominance. The C919 is more than an airplane. It's a symbol of China's ambition to become a technological superpower. By powering this aircraft, GE is both enabling a competitor and securing its own future in a changing world. The deal highlights the deep, often contradictory interdependencies of the global economy, where rivals are also partners. While Washington and Beijing spar over trade and technology, corporations like GE navigate the treacherous landscape to protect their interests. For Western companies, decoupling from China's massive economy is nearly impossible if they want to remain global leaders. GE's decision to supply the C919 is a pivotal chapter in the unfolding drama of global aviation, with implications for supply chains, trade policy, and the balance of technological power. The C919 may look like any other modern passenger jet, but it's the centerpiece of Beijing's Made in China 2025 strategy. Developed by state-owned COMAC, the C919 aims to break the decades-long duopoly of Boeing and Airbus in the global aviation market. China is set to become the world's largest aviation market, and the C919 is designed to capture a big share of that demand. This isn't just about economics, it's a strategic move to reduce China's reliance on foreign suppliers. While the C919 is currently certified mainly for Chinese skies, COMAC has secured hundreds of domestic orders, backed by political and financial incentives. The plan: dominate at home, refine the aircraft, and then push for international sales. But building a trusted global brand is a massive challenge. Boeing and Airbus have decades of reputation and infrastructure. The C919's success will depend on convincing regulators, airlines, and passengers that it's as safe and reliable as its Western rivals. For now, the C919 is a bold statement of intent, but its journey to global acceptance is just beginning. The C919's heart is the LEAP-1C engine, a marvel from CFM International, a GE and Safran joint venture. This $2.2 billion engine deal was essential for the C919's competitiveness and survival. But as U.S.-China tensions escalated, the U.S. government temporarily banned the sale of American jet engine parts to China, citing national security concerns. The C919 program was thrown into crisis, exposing its dependence on Western technology. In May 2025, the U.S. Commerce Department reversed course, reinstating export licenses, a tactical move to de-escalate trade tensions and protect GE's global business. GE's stock rebounded, reflecting Wall Street's faith in the deal. The U.S. government decided the economic benefits outweighed the risks, preferring to keep leverage over China's aerospace industry rather than cut ties completely. This saga highlights the delicate balancing act: how to compete with China without severing economic ties. The engine deal's on-again, off-again nature is a microcosm of the broader U.S.-China relationship. For now, pragmatism wins, but the future remains uncertain. The C919 is a symbol of the turbulent U.S.-China relationship, caught in the crossfire of strategic competition. U.S. trade policy has shaped the project's fate, with export controls on key technologies like avionics creating persistent uncertainty for COMAC. American firms such as Honeywell and Collins Aerospace supply critical systems, but every shipment is subject to shifting regulations. The U.S. allows sales of some high-value components like engines, while restricting others deemed sensitive. This selective restriction is splitting the global aerospace supply chain into Western and China-aligned spheres. For companies, this means navigating two sets of standards and regulations, a costly, complex reality. The uncertainty also threatens the C919's chances for international certification, as regulators hesitate to approve an aircraft vulnerable to supply disruptions. Without global validation, the C919 may remain largely confined to China's domestic market. Trade tensions aren't just slowing production, they're limiting China's ability to challenge Boeing and Airbus on the world stage. The C919's global ambitions are hostage to geopolitics. Despite its Made in China branding, the C919 is a product of deep international collaboration. Comac assembles the jet, but most complex components come from Western aerospace giants. This reliance is both a strength, enabling rapid development, and a vulnerability, leaving the program exposed to foreign policy shifts. U.S. trade restrictions have already caused production bottlenecks and delayed international certification. Finding alternative suppliers for critical systems is a monumental challenge, requiring years of testing and validation. China's goal is technological self-sufficiency, but for now it must rely on the very companies it seeks to rival. The GE engine deal buys time but doesn't solve the underlying dependency. The C919's journey is a lesson true technological sovereignty is a long, difficult road. For now, China's aerospace ambitions remain tethered to a fragile global supply chain. The path to independence is steep, and the world is watching. Beijing sees reliance on Western engines as a strategic vulnerability and is determined to fix it. China is pouring resources into developing its own high-bypass turbofan, the CJ1000A, led by the Aero Engine Corporation of China. Mastering jet engine technology is an immense challenge, achieved by only a handful of companies worldwide. Investment in the CJ1000A has soared, but early prototypes still lag behind Western standards for reliability and efficiency. It may take a decade or more before China's engine is a true rival to the LEAP-1C. For now, Western suppliers like GE and Safran remain indispensable. But every engine delivered to China is a potential learning opportunity, accelerating indigenous development. Once China perfects its own engine, the multi-billion-dollar market for Western suppliers could shrink dramatically. The race for self-sufficiency is on, and the stakes couldn't be higher. The US-China tech rivalry is creating new winners and losers in global aerospace. While US avionics suppliers face uncertainty, European firms like Safran and Thales are seizing opportunities. Safran, GE's partner in the LEAP engine, benefits directly from every sale to China. Thales, specializing in avionics, is well positioned to fill gaps left by US export controls. European companies are seen as more reliable partners, less subject to political swings. Russia too is watching closely, with potential for deeper collaboration if Western restrictions tighten. US policies aimed at slowing China's rise may inadvertently boost European and Russian competitors. The C919 story is global, with ripple effects reshaping alliances and market shares. As the chessboard shifts, new economic realities are emerging across continents. For American aerospace suppliers, the C919 saga brings profound uncertainty. The GE engine license is a relief, but it's a temporary reprieve. Future policy could shift at any moment. Companies like Honeywell face a dilemma: huge opportunities in China, but the risk of sudden export bans. This makes long-term planning nearly impossible, as supply chains and investments span years. The inability to guarantee stable supply threatens both revenue and reputation. The GE deal is a bellwether for the entire US aerospace sector, showing that high-value deals may survive, but others remain in limbo. The mixed signals from Washington create an uneven playing field, picking winners and losers among US firms. Investors now see established giants like Boeing and Airbus as safer bets, given their global diversification. The anxiety among American suppliers highlights a core dilemma: how to compete globally when your biggest market is also your biggest rival. The stakes for US industry have never been higher. The GE deal and the rise of the C919 signal a fundamental shift in global aviation. For decades, Boeing and Airbus ruled the skies. Now, China is emerging as a serious challenger. The C919's arrival is forcing a split in supply chains and standards, creating Western and China-aligned ecosystems. Airlines may soon make choices based on geopolitics as much as performance. The seamless global network we know could become more fragmented and complex. The GE deal shows that economic interdependence between the US and China is too deep to sever easily. For GE, it's a foothold in the future. For China, it's a step toward self-sufficiency. This partnership of necessity is shaping the next era of aviation. The C919's journey will be long, but its impact is already being felt. GE's $2.2 billion bet isn't just on a plane, it's on the future of the global economy.